Well, welcome to another edition of Wealthy and Wise. I'm your host today, Adam Kinte, Executive Corporate Analyst here for Nevada Corporate Headquarters. And I have with us an amazing man, Mr. David Van Landingham, as our guest today. And David, you've been with NCH for many years. How many years?
14, 15, I lose track after a while.
So yeah, he's a staple in our company and absolute wealth of knowledge and genius when it comes to the tax planning and tax strategies side of things. I thought there's nobody better than the guy who directs the CPAs on the best way to do things. So David, welcome.
Thank you, Adam. It's always a pleasure. I think the last time we were together, we were doing end-of-year tax strategies, right? And now we're talking about strategies for 2026, which is going to be just, full of new stuff from the One Big Beautiful Bill Act. And a lot of things have disappeared and gone away. And some things are going to shock some people. They don't even think about some of these things. The tax code is so deep and wide, sometimes we don't get to see everything, just everything that hits the news and the social media.
Well, and there's always this approach that when it comes to the tax side of things, we're all going to have to pay taxes on whatever money we're making. But how you do it, it makes a huge difference. And so I want to highlight, we work with a lot of business owners and a lot of investors, whether it's stock market investors or real estate investors, regular businesses of any kind. We're always looking at what is the best way for us to take advantage of all of the quote unquote loopholes that the IRS has created for us to save money in taxes. And being a business owner, you're just open to so many things that you can write off as a business expense and so many things that you can do just a little bit different that ends up saving thousands of dollars in taxes. So the best way to do that is to start the year right and make sure you start with a conversation. If you don't have a CPA or a tax professional you work with, please do reach out to NCH. We have an amazing CPA firm that can work with you and help you. But there's so many things that we can do on the planning side of things. So David, I want to talk about some of the changes that we have in 2026. And to start with, let's talk about the big one I see as a huge advantage for business owners and investors is the bonus depreciation. So can you kind of unpack for us what was set to happen and what actually did happen when it comes to the bonus depreciation?
Yeah, so a lot of people get confused when you hear bonus depreciation. Some people think of the 179, right? So there's the 179, there's the 168. So the 168 has been in the process of sunsetting for the last 3 years. This fourth year, this will be would have been the final year in 2027. It would have been completely phased out. But that has come back and has been made permanent. And it's an incredible, absolutely massive move for business owners because this allows you to accelerate that process instead of, taking 5 years or 15 years to write something off. It allows you to write off 100%, but it's only for asset classes of 20 years or less, right? So it's not your rental property at 27 and a half years or commercial property at 39 years. It is for those things that have a low one. The key and why I like this one so much over the 179 is because the 179 doesn't let you create a loss, right? But the 100% depreciation does, and you can take that loss, you can carry forward that loss. There's all kinds of wonderful things to do with it. And other things that are important about it is that, you can take certain categories. I know you and I talk a lot about Airbnbs, and I have a client that went out and bought an Airbnb, but didn't have a pool and wanted to put a pool in there, but was like, man, how am I going to do this? That's going to be expensive. It's going to take me forever to recapture that. Well, you can do improvements to that land of that house and put a pool in and a deck and a fence and all those things and depreciate that 100% that year if you want to. Or you can break it up over a number of years. You can decide how you want to deploy that 100% depreciation.
So when we talk about the 168 and 179, these kind of get technical numbers, but these are tools that your CPA has at their disposal to be able to do good work for you. And that's why I always like that, people think about doing taxes when tax time rolls around. Oh, you're in a business or an investor. You should be working with your CPA throughout the year. So being aware of these things and doing it right. Another big one that I wanted to cover, David. So on the 179, we have a lot of people that will buy, for example, an Airbnb or sometimes just a rental property, and we're able to get this bonus depreciation. They have high W-2 income. And normally your real estate is passive income. It does not offset your passive losses. Passive losses don't offset your other income unless you make less than $100,000 a year. Then it will. But if you're over $100,000, you're $2 above 100 grand, you lose $1 in passive losses. So by the time you've made 150,000 as your modified adjusted gross income, none of those depreciation losses are going to offset your other income. This is where a lot of people look at becoming a real estate professional and qualifying as an RE pro so that those passive losses will offset their active income. I have a lot of clients that they work very hard and they will buy a property, do the Airbnb loophole, get massive tax savings, and then hire a property manager to manage things. Though they have to manage it the first year, but really big tax incentive on that side of things. Or if you have a small business, David was talking about if you had if you better the 179, you can expense out a new vehicle, but it depends on how much money you make, where you might not be able to take those losses that you get. Well, with the bonus depreciation, those rules are out the window. It's more advantageous for you as a business owner to have that bonus depreciation option. Now, another one that is, again, because we're at the beginning of the year, the SALT tax deduction. So many of you are in a high income tax state where the writing off the state and local taxes can make a significant difference. But those got to be paid properly. So David, can you talk a little bit about the SALT deduction and where it was and where it's going for 26?
Yeah, I mean, it's real simple. It was at 10,000. Now it's at 40,000, right? So, wow, that's pretty impressive. So if you've got, properties out there and you're in a high tax state, like you mentioned, where property taxes are high and mortgage interest is not the best. Now, you've got something there that can help relieve that burden where you're capped at 10,000. Now you can go up to 40,000. And that's money in the bank. I mean, in the cash flowing world of rental properties, that can make a huge difference.
Oh, and something to think about there's the federal laws and then there's state laws. And there's a lot of states that do not mirror the federal law. So have that conversation with your CPA because they call them workarounds. So workaround to some of those limitations and being able to write off your state and local taxes is if you have an S-Corp or if you have a partnership, if the partnership pays certain taxes, you get to sidestep some of those rules. So if you're in one of those high income tax states and you have a business, make sure that you include that as part of your conversation with your CPA or your tax professional is how to do those correctly and which accounts are paying what, am I paying it out of my personal account or should I pay that out of the business account when it comes to some of those taxes? So that's really important. So we have the bonus depreciation is now it's permanent. We have to worry about that changing because it was going to sunset to like nothing. You wouldn't get much tax benefit. We've got the SALT tax deduction that's gone up, which is huge. A little one is if you have to buy a new car. Tell us about that with the interest write-offs.
Yeah, I mean, 100% interest write-off if it's an American-made car. Bringing everything back to the United States. So that's another huge benefit. We're seeing more and more benefits related around transportation and vehicles. If you're not in a position to buy a car, but you're going to be using your personal vehicle, mileage is now up to 72.5 cents per mile. So depending upon what kind of car you got, you may be actually making money while you're driving. So just took a trip over to meet with the client, 200 miles away, 400 miles round trip, 72.5 cents a mile. I'm making money. Score.
Good. And and something that's unique is that previously you had to be a business owner to be able to write off the interest or things for your vehicle. Well, now, as a regular old individual, you don't even have to have a business. You get to write off the interest on your vehicle. As long as it's an American-made car, you get to write off interest on a vehicle. So, and David, is that just for new cars or that's just a new to you car?
New to you car. That's a beautiful thing. And there are certain circumstances where leases kind of work, but they're a little bit more complex. But yeah, new to you car. Now you can't take your car and sell it to yourself or your company. It's new to you.
Well, I just got off the phone with the client that has some restaurants and other things. And his tax professional had never told him about making an S election. And that is really, really important at the beginning of the year. If you have an LLC that you've had for a while and you've been operating as a disregarded LLC, meaning that you're not filing a separate business return, all your business activity reports on your personal return. Well, the problem is you're getting hammered in taxes. And by electing for an LLC to be taxed as an S corporation, we can significantly reduce the amount you pay in Social Security and Medicare tax. And Dave, what was the for Social Security? It's 12.4% on the first. I'm not going
184,500.
So the first $184,500, you're paying 12.4% for Social Security, and then 2.9% for Medicare. Combined, the self-employment tax is 15.3%. So that 15.3 is on the first 184.5. As a business owner, the IRS allows you to pay yourself a small, reasonable salary. Reasonable is different for everybody, but a much smaller salary, and significantly reduce that tax bill. If your business made $100,000, if you took a $30,000 salary, you go from paying in $18,300 down to $45,900, potentially saving you $10,000 in Social Security and Medicare tax. But those things the elections have to be made at the beginning of the year. So we got 75 days from the date of incorporation or 75 days from the year-end date to make those S elections appropriately. So it's, again, reasons why you should be talking with your accountant, make your tax professional to make these elections. That the guy that had the restaurant been operating for 7 years, and his accountant never told him about this. And we look back over the last 7 years and the thousands of dollars that we calculated that last year we'd have saved him about $12,000 in Social Security. That's $1,000 a month that he would get to keep had he done this properly. So not all accountants and CPAs are created equal, and that's what we love about working with our team here at NCA. Our CPA firm specializes in working with business owners and investors, so we can help with those things. But David, we had a short time today. We're going to have a lot more great topics coming up throughout the year. So thank you so much for taking time out of your day, and we'll see you on our next edition of Wealthy and Wise. Be sure to like, subscribe, and share.